The stock market is doing something that makes no sense on the surface. Every traditional model says it should be sinking, yet it keeps pushing higher, as if gravity no longer applies. Earnings are slowing, household debt is exploding, global uncertainty is rising, and still the charts climb upward. It feels less like a market responding to economic strength, and more like something powerful operating behind the scenes, something engineered, something intentional. What you're seeing today isn't a natural reflection of economic reality. It's the outcome of a financial system redesigned over the past decade and a half, one that rewards asset owners, punishes savers, and depends on constant intervention to survive. Understanding this shift isn't optional anymore. It determines who builds wealth and who gets quietly left behind. If you've ever wondered why markets rise while daily life gets harder, this breakdown will finally make everything click. For over a century, financial models followed a simple logic. Strong earnings, stable growth, and healthy economic conditions lead to rising markets. When those factors weaken, markets fall. But the system we're living in now no longer obeys those rules. The stock market isn't reacting to fundamentals. It's reacting to liquidity, policy decisions, and engineered financial conditions. Each time a major downturn threatens to form, something steps in to cushion the fall. Rate cuts, emergency programs, liquidity injections, or forward guidance statements that pacify investors. This cycle repeats so consistently that declines barely get a chance to build momentum before intervention reverses them. This is why analysts sound confused. They're using tools designed for a world where markets were driven by business performance. Today's markets are driven by policy, psychology, and forced participation. The game changed, but most people still think it works the way it used to. To understand why stocks refuse to fall, you first have to understand the new forces determining their direction, forces that barely existed 20 years ago. The first major force is the quiet flood of liquidity that has become the foundation of the modern financial system. Since 2008, central banks around the world have pumped unprecedented amounts of new money into circulation. This wasn't money earned through productivity or innovation. It was created digitally and injected straight into the financial sector. When new money enters the system through banks and large institutions, it doesn't flow into wages or small businesses. It flows into assets, stocks, bonds, real estate. Because the number of available shares doesn't rise nearly as fast as the amount of new money chasing them, prices climb simply from the imbalance. Liquidity doesn't just lift the market, it transforms how the market behaves. Price discovery, once the backbone of capitalism, becomes distorted. Expensive assets can become even more expensive because demand is being fueled artificially. Photographed as long as liquidity keeps flowing, risk-taking continues. When liquidity tightens, fear returns. But the past decade has shown a clear trend. Whenever fear spikes, liquidity returns quickly. That's why markets rise faster after every crisis. They're being lifted by a system that has become addicted to fresh money. Another major driver is something economists call the wealth effect, the idea that people spend more when they feel richer. Central banks depend heavily on this psychological trigger. If stocks rise, homeowners and investors feel confident. When they feel confident, they spend. When they spend, the economy appears healthier. This means asset inflation isn't a side effect. It's part of the strategy. But this strategy comes with a built-in trap. The moment asset prices fall significantly, confidence evaporates and spending slows. So to avoid economic contraction, policymakers have a strong incentive to keep asset prices rising. This is why every major downturn is met with immediate support. If stocks collapse, consumer demand collapses, and the entire economy suffers. Policymakers can't allow that, so they intervene again and again. Over time, investors have learned this pattern. They now assume that every major decline will be stopped. This belief encourages more risk-taking, which pushes prices even higher. What began as a temporary strategy has now become a permanent requirement, a loop that continues because stopping it would be catastrophic. The third mechanism is something most people never hear about: financial repression. It sounds complicated, but it's simple at its core. When interest rates are kept low, safe investments like savings accounts and government bonds become financially useless. They no longer protect purchasing power. They no longer offer growth. This leaves institutions, pension funds, insurance companies, retirement plans, with no choice but to move into riskier assets. They must meet return targets, and the only way to do that in a low-rate environment is to buy stocks, real estate, or private equity. This isn't optional. These institutions are legally responsible for generating returns for millions of people. If they sit in cash, they fall behind inflation. If they hold bonds, the yield is too low to meet obligations. So they're forced into equities, even when valuations are extreme. This guaranteed, unstoppable demand creates a constant upward push on markets. It's not enthusiasm. It's not optimism. It's mechanical buying driven by policy constraints. In a normal market, valuations matter. In today's environment, mandatory participation creates a price floor that keeps markets elevated, even when fundamentals weaken. For decades, analysts relied on valuation metrics, price-to-earnings ratios, profit margins, debt levels, growth trends, to estimate where markets were headed. Those tools worked when markets reflected economic activity. But today, policy-driven forces overwhelm traditional indicators. Wolfgang says stocks should fall. Liquidity pushes them up. Paycheck patterns point to a correction. Central banks intervene. When valuations reach extreme levels, financial repression forces institutions to buy anyway. Sluggish signals that once predicted downturns now predict nothing. Markets can look dangerously overvalued, yet continue rising for years. Warning signs that used to spark sell-offs barely move the needle. This disconnect makes the modern market feel unpredictable, but it's only unpredictable if you're using an outdated playbook. Once you understand the underlying mechanisms, the behavior becomes much clearer. Combating rise not because they should, but because the system depends on them rising. Every major lever of modern economic policy is designed to protect asset prices. That's why economists and analysts are constantly confused. The financial world they studied no longer matches the financial world we live in. While rising asset prices feel great for investors, the cost is quietly passed to everyone else through inflation. Newly created money doesn't stay in financial markets. It eventually makes its way into the cost of living. Housing becomes more expensive because cheap money fuels bidding wars. Healthcare costs rise because institutions can absorb endless price increases. Concealed spikes because easy credit allows schools to charge more. Everything essentials creep upward because inflation hides in places most people don't notice. Misguided a silent divide. The top of the economic ladder benefits because their assets grow. The bottom and middle struggle because their wages don't keep up with rising prices. Markets keep climbing, but the average household feels poorer every year. This mismatch between financial prosperity and real-life struggle is the core of the modern economic imbalance. It's not an accident. It's a predictable outcome of policies that inflate assets faster than incomes. As long as the system relies on asset inflation to function, the cost of living will continue rising faster than most people can manage. Corporations have learned how the new financial system works, and many have adjusted their strategies accordingly. Instead of focusing on innovation, expansion, or workforce development, they increasingly favor financial engineering. One example, stock buybacks. Companies borrow money at extremely low rates, use that borrowed cash to repurchase their own shares, and shrink the share count. This makes earnings per share appear stronger, even when actual performance is stagnant. Stock prices rise, executives earn bigger bonuses, and shareholders see gains, despite no real improvement in the company itself. Forging on market appearance over real productivity distorts the economy. Investment in long-term innovation slows. Wages stagnate. Capital flows into stock manipulation instead of problem solving. Smaller businesses, meanwhile, face pressures they cannot match. They don't have access to cheap financing. They can't manipulate their stock price. They're competing in an environment where financial power matters more than operational excellence. Conserve rewards scale and leverage, not real value creation. Young adults entering the economy today are facing a completely different reality from previous generations. Asset inflation has pushed the price of homes, education, and investment opportunities far beyond what normal incomes can support. Saving for a down payment is nearly impossible when housing costs rise faster than wages. Building a retirement portfolio is harder when market entry points are expensive. Starting a business is riskier when operating costs and debt obligations dominate the landscape. BK California wasn't designed with this generation in mind. It was designed to rescue the last crisis, which unintentionally created new barriers for younger people. As a result, the wealth gap grows, not because of laziness or poor choices, but because the financial ladder keeps moving higher. The rules that once allowed ordinary families to build stability, affordable housing, accessible education, rising wages, have eroded under the pressure of asset-dependent policies. This generational strain is one of the strongest signs that the system is nearing its limits. Every system built on continuous intervention eventually reaches a point where the cost of maintaining stability grows faster than the stability it produces. Each market rescue requires more money than the last. Each crisis demands more aggressive measures. Each slowdown pushes policymakers toward increasingly extreme decisions. This is known as diminishing returns, the idea that the tools used to support markets lose effectiveness over time. The same amount of liquidity that once lifted stocks dramatically now barely stabilizes them. The wealth effect relies on ever higher prices to maintain confidence. Financial repression forces institutions into greater risk as safe yields disappear. Eventually, the system encounters real-world limits, inflation pressures, political backlash, social fragmentation, or simple mathematical constraints. No one can predict the exact moment these pressures collide, but the trajectory is clear. The system requires more support each year, and the political tolerance for these interventions is shrinking. Understanding this helps investors prepare, not panic. Knowing that markets are artificially elevated doesn't mean you should avoid them. It means you should approach them strategically, with an understanding of how the system actually works. Rule 1. Don't fight unlimited liquidity. Betting against policymakers who can create money at will is almost always a losing strategy. Porcelain 2. Know which sectors benefit most from policy-driven markets. Industries tied to government spending or cheap credit consistently outperform. Prosecute Rule 3. Expect volatility. When markets depend on intervention, they also react dramatically when that intervention slows. Legalize 4. Diversify based on policy exposure, not just asset class. Traditional diversification fails when everything moves in the same direction due to liquidity changes. Navigating this environment isn't about predicting exact market peaks. It's about recognizing the forces shaping each move and positioning your portfolio accordingly. Understanding this new financial era gives you an edge over people still relying on old models that no longer apply. You're living through an economic era unlike anything in history. Markets rise for reasons that have little to do with earnings or productivity, and everything to do with liquidity, intervention, and structural pressure. Most people never question why stocks climb while their daily life gets more expensive. They accept the headline without understanding the machinery behind it. Brigham to now see the system for what it really is, a powerful, policy-driven engine that keeps asset prices elevated at almost any cost. That knowledge is your advantage. It allows you to prepare intelligently, invest strategically, and avoid the traps that blindside others. If you want to stay ahead, not just hopeful, not just reactive, but genuinely informed, subscribe and stay connected. Here we break down the signals that matter, the patterns policymakers rely on, and the shifts that ordinary investors never notice until it's too late. Isn't about fear. It's about clarity. Wilmington.com, positioning yourself where opportunity still exists, even in a distorted market. And it's about protecting your future while others are distracted by headlines. Hezbollah, and join this journey. The next chapter of the financial system is coming, and you'll want to understand it before it arrives.